The auto industry has been lying to you for months. While experts and mainstream media keep pushing the narrative that the economy is strong, vehicle sales numbers just revealed the shocking truth. American consumers are broke, desperate, and rapidly pulling back from major purchases. CarMax, the largest used car retailer in America with over 200 locations nationwide, just dropped a financial bombshell that has Wall Street analysts panicking and economic forecasters scrambling to revise their predictions. The numbers are brutal and undeniable. Total retail used vehicle sales plummeted 5.4%. Comparable store used unit sales crashed an even worse 6.3%. Wholesale unit sales down another 2.2%. Overall revenue collapsed by a staggering 7.2%. But the real story isn't just in the numbers, it's in what CarMax CEO Bill Nash admitted on the earnings call that has industry insiders terrified about what's coming next. Despite used car prices actually falling, consumers are showing unprecedented angst and price sensitivity, Nash revealed. We're seeing behavior we haven't witnessed before, even compared to previous economic downturns. Translation: even though cars are getting cheaper, Americans still can't afford them or are too worried about their financial future to make major purchases. This isn't just about cars anymore. When the largest used vehicle retailer in the country, a company with its finger directly on the pulse of middle-class spending, sends up a warning flare this serious, it's time to pay attention. Because what's happening at CarMax dealerships across America right now could be the canary in the economic coal mine that nobody wants to talk about. Everyone knows car sales fluctuate with the economy, but what most people miss is that the used car market serves as the most accurate real-time indicator of everyday Americans' financial health. Unlike housing data that lags by months or employment numbers that get constantly revised, CarMax's sales data provides an unfiltered look at how middle and working-class Americans are really doing right now, and the picture it's painting is disturbing. The conventional wisdom suggests that when new car sales decline, used car sales should increase as consumers seek more affordable options. But that's not happening. Both new and used markets are contracting simultaneously, with CarMax at the center of this economic storm. But here's the twist that financial media isn't covering. It's not just that sales are down. It's that they're down despite used car prices actually falling by over 11% year over year. In a normal market, lower prices should stimulate demand. Instead, demand is collapsing alongside prices, a clear sign of deeper economic distress. What CarMax's numbers reveal isn't just an automotive industry problem, it's a warning that the American consumer, the engine that powers nearly 70% of the entire U.S. economy, is rapidly running out of gas. What's really causing this collapse in car sales despite falling prices? And what does it tell us about the true state of the American economy that mainstream sources aren't reporting? To understand the magnitude of what's happening, we need to look deeper into CarMax's financial report and the CEO's unusually candid comments about consumer behavior. CarMax isn't just any automotive retailer. With over 200 locations and as the largest used vehicle seller in the country, they have real-time data on middle-class spending habits across every region of America. When they report a problem, it reflects what's happening in households nationwide. The headline numbers are alarming enough. Retail sales down 5.4%, comparable store sales down 6.3%, and revenue collapsed by 7.2% year over year. But the real story emerges in the details and executive comments that reveal why these declines are happening. What we're seeing is unprecedented consumer hesitation, explained Bill Nash on the earnings call. Even as vehicle prices have moderated and in some segments actually declined significantly, consumers are exhibiting extreme price sensitivity and reluctance to commit to major purchases. This statement contradicts the basic laws of economics. When prices fall, demand is supposed to increase. That's not happening in the used car market, a clear sign that something is fundamentally broken in consumer spending power. Even more concerning is what's happening with auto loans. CarMax. Auto finance income has decreased substantially, but their provision for loan losses, money they expect to lose from customers who can't pay, has increased dramatically. This means more Americans are falling behind on car payments, a leading indicator of financial distress that typically precedes broader economic problems. We're seeing default patterns that are concerning, admitted Nash when pressed by analysts. The consumer is clearly under pressure across all income brackets, but particularly in middle and lower income segments. Industry experts find this especially alarming because used vehicles are typically the last major purchase category to show weakness. When consumers pull back from used cars, it suggests their financial cushion has been completely depleted. The used car market is the ultimate indicator of middle-class financial health, explains Robert Johnson, an automotive industry analyst with 20 years of experience tracking consumer spending patterns. These aren't luxury purchases that can be easily deferred. When someone needs transportation to get to work and still can't afford a used car, even with prices falling, it tells you they've exhausted all their financial resources. Perhaps most troubling is the regional data buried in CarMax's report. Sales declines aren't limited to traditionally weaker economic areas. They're happening across the country, with some of the steepest drops in regions that had been considered economic strongholds. What makes this situation different from previous downturns is how widespread the weakness is. Johnson continues, "In past recessions, we'd see certain regions holding up while others struggled. Now we're seeing synchronized decline across all markets. That's rare and suggests a systemic problem rather than a localized one." The central question becomes unavoidable. If Americans can't afford used cars when prices are falling, what else can't they afford? And how much longer can the broader economy continue before this consumer weakness spreads to other sectors? This isn't just about cars anymore. CarMax's shocking sales report represents the early warning system for a potential economic crisis that could affect every American household in the coming months. Used vehicles occupy a unique position in consumer spending. Unlike designer handbags or vacation packages, they aren't easily discretionary for most Americans. People need reliable transportation to get to work, take children to school, and handle basic life necessities. When consumers pull back from this essential category despite falling prices, it signals severe financial distress. The patterns we're seeing in the CarMax data align perfectly with what happens 12 to 18 months before a significant economic contraction, explains financial analyst Michael Stevens, who specializes in consumer spending trends. It's like watching storm clouds gather on the horizon. You might not be getting wet yet, but rain is definitely coming. The consequences extend far beyond the automotive industry. Used car sales directly impact multiple sectors of the economy. Banking and finance will feel the immediate effects as auto loan defaults rise. CarMax's increased provision for loan losses isn't an isolated trend, it's being mirrored across major auto lenders nationwide. As defaults increase, banks tighten lending standards even further, creating a negative feedback loop that restricts credit access precisely when consumers need it most. Insurance companies face declining premiums as fewer cars are sold and more people try to reduce coverage to save money. This sector, which employs hundreds of thousands of Americans, could see significant job cuts if the trend continues. Auto parts retailers and service centers are already reporting revenue declines as consumers defer maintenance and repairs. AutoZone and O'Reilly Auto Parts have both missed earnings expectations in recent quarters, citing reduced customer traffic. Local tax revenues will suffer as vehicle sales and registration fees decline, potentially affecting everything from road maintenance to school funding in communities across America. But the most alarming aspect of CarMax's report is what it reveals about the true state of the American consumer. For years, we've been told that household balance sheets are strong, savings are robust, and the job market is resilient. If all that were true, used car sales should be stable or growing, especially with prices declining. The disconnect between the official economic narrative and what the CarMax numbers show is staggering, Stevens continues. Either Americans suddenly decided they don't need cars, which is absurd, or their financial situation is far more precarious than government statistics suggest. This precarious situation is further evidenced by the rapid rise in revolving credit card debt, which has now surpassed $1 trillion nationally. Americans are increasingly using high-interest credit cards to cover basic expenses as savings accounts dwindle and real wages fail to keep pace with inflation in essential categories like food, housing, and healthcare. We're witnessing the final stage of consumer resilience, warned Stevens. First, people spend down their pandemic savings. Then they tap home equity if they have it. Finally, they max out credit cards. After that, there's nowhere left to go except drastically cutting spending, which is exactly what the CarMax data suggests is now happening. The implications for the broader economy are severe. Consumer spending accounts for approximately 70% of U.S. GDP. If the weakness shown in CarMax's report spreads to other retail categories, and early data from retailers suggests it already is, the economy could contract much more sharply than most forecasters are currently projecting. Here's where this story takes an unexpected turn that exposes what's really happening beneath the surface of America's so-called strong economy. While researching CarMax's financial collapse, I discovered something that connects all the dots. Something that mainstream financial media either doesn't understand or doesn't want you to know. This isn't just a normal economic downturn, it's the inevitable result of the greatest monetary experiment in human history, and the hangover is just beginning. Between March 2020 and March 2022, the Federal Reserve created nearly $5 trillion out of thin air and injected it into the economy. This unprecedented money printing temporarily masked the pandemic's economic damage by artificially inflating asset prices and creating a false sense of prosperity. But that artificial stimulus created distortions throughout the entire economy, nowhere more visible than in the automotive market. Used car prices skyrocketed by over 40% in 2021, an increase that defied all historical norms and basic economic principles. What we're witnessing now with CarMax isn't a mysterious consumer pullback, explains Dr. Michael Harrison, an economist who studies monetary policy effects on retail spending. It's the inevitable correction after the biggest asset bubble in automotive history, a bubble created directly by federal policy. The Federal Reserve has now reversed course, raising interest rates at the fastest pace in 4 decades to combat the inflation their own policies created. These higher rates have made auto loans significantly more expensive. The average used car loan rate has jumped from 4.0% in 2021 to over 9% today for prime borrowers, and well into the teens for those with less than perfect credit. The monthly payment on a typical used car has increased by nearly 40% compared to 3 years ago. Harrison continues, "That's not because the cars are better or more valuable, it's entirely due to interest rate changes." This payment shock comes precisely as pandemic-era savings have been depleted for most Americans. The personal savings rate has plummeted from a high of over 30% during lockdowns to under 4% today, lower than before the pandemic. But here's the real twist. CarMax's collapse is actually a leading indicator of a much larger economic realignment that's only just beginning. The massive distortions created during the pandemic era, from housing to equities to consumer spending, are all starting to unwind simultaneously. What makes this situation particularly dangerous is that consumers have never faced this combination of factors before, warns Harrison. They're dealing with the highest interest rates in 20 years. Persistent inflation in essential categories like food and housing, the end of pandemic support programs, and the resumption of payments on trillions in previously deferred obligations like student loans. Internal documents from major banks and credit card companies reveal they've been quietly preparing for a significant increase in defaults across multiple consumer lending categories, not just auto loans. These financial institutions have been increasing loan loss provisions and tightening lending standards in anticipation of what some analysts are calling a consumer credit event in 2025. This isn't a normal economic cycle. It's the painful unwinding of the most extreme financial experiment in modern history, and CarMax's disastrous sales report is simply the first major warning sign that the bill for this experiment is finally coming due. The auto industry's lie has been exposed. While experts kept telling us everything was fine, CarMax just confirmed what many Americans have felt in their daily lives for months. This economy is in serious trouble. The numbers don't lie. Used vehicle sales down over 5% despite falling prices. Revenue collapsed by more than 7%. And most telling of all, Americans aren't buying essential transportation even as prices drop, a clear sign that financial distress has reached critical levels for millions of households. CarMax CEO Bill Nash's admission about unprecedented consumer angst, despite lower prices, should be front-page news across America. It directly contradicts the polished narrative about a strong economy and resilient consumer that we've been fed by financial media and government officials. What we're witnessing isn't just an automotive industry problem. It's the canary in the economic coal mine. an early warning system flashing red about the true state of middle-class finances nationwide. The used car market has always been the most accurate real-time gauge of everyday Americans' financial health. Unlike housing data that lags by months or employment figures that get constantly revised, CarMax's sales data provides an unfiltered look at what's really happening in households across the country. And the story it's telling is disturbing. American consumers are broke, stressed, and pulling back from essential purchases even as prices fall. The foundation of our consumer economy, responsible for 70% of GDP, is showing dangerous cracks that can no longer be ignored or explained away. The warning signs are flashing brighter than ever. CarMax's financial disaster isn't happening in isolation, it's part of a broader pattern of consumer retreat that threatens to undermine the entire economic recovery narrative we've been sold. This isn't just about selling fewer cars, it's about what happens next as this consumer weakness spreads to other sectors. Triggering the economic domino effect that history shows follows exactly this pattern of declining auto sales. The question isn't if this contagion will spread to other industries, it's how quickly and how severely the impact will be felt throughout the economy that depends almost entirely on the American consumer's willingness and ability to spend. CarMax has sounded the alarm. The only question that remains is whether we'll heed the warning before it's too late.